Thanks for staying with us on SABC News. Asia and Hong Kong stocks fell on Tuesday as investors locked in gains after a strong rally that was fueled by record monthly foreign inflows, although analysts predict further upside ahead, citing growing signs of a post-COVID economic meltdown. The recent market rebound was fueled by strong foreign money inflows as global funds bet on China recovery after Beijing dropped strict COVID curbs last month. Now, despite the week-long Spring Festival break, China's on-store stock market witnessed roughly 140 billion yuan, or around over $20 billion in net foreign buying via Stock Connect in January, registering the biggest monthly inflows on record. It also surpassed total inflows in 2022. So China's blue chip CSI 300 index lost 0.8% by the lunch break, while the Shanghai Composite Index fell 0.4%. When we go to Hong Kong, their benchmark Hang Seng Index dropped 1.3%. Going to the United States now, major U.S. stock indexes sank, weighed down by declines in technology and other mega cap shares on Monday, as investors look towards a major week of events, including central bank meetings and a slew of earnings reports. Shares of Apple Inc., Amazon Inc., and Google parent Alphabet all slumped. The S&P 500 lost 1.30%, the Nasdaq Composite lost 1.96%, and the Dow Jones Industrial Average fell 0.77%. The JSE is in negative territory at this hour. The all-share index has declined by over 1% to 79,412. The Industrial 25 index has shed 0.8%. Financials are 0.5% weaker, and the top 10 resources index has weakened by almost 2.5%. Markets in Europe following the global trend to trade weaker. Britain's FTSE 100 has declined by 0.7%. The CAC 40 in France is 0.6% down, and Germany's DAX is just over 0.5% lower. When we come to commodities, gold is trading at $1,904. Platinum at $994 per ounce, while the price of a barrel of Brent crude oil is $83.82. The rand trading at 17 rand and 46 cents to the dollar, 21 rand and 49 to the pound sterling, and 18 rand 89 to the euro. Right, let's get some analysis on this. Martin Smith from Anchor Capital joins me now. Very good afternoon to you, Martin. With that Fed announcement looming, why are we seeing a loss in the dollar?
So I think it's a couple of things. I mean, what you've seen is that the dollar has been very, very strong in the back of last year's kind of risk-off appetite. And a lot of the pricing of higher yields also saw flows into dollar assets. But now, as we are hopefully getting towards the back end of interest rate hiking cycle in the States, you're seeing the dollar flowing into other places, like, for example, China, you mentioned, has had a record month. South Africa has done very well. Risk appetite has been returning a little bit in the last few weeks. Obviously, today and yesterday, you saw some investors taking some funds off the table after kind of really good profits in the last couple of weeks. And also, I think, ahead of the Fed's decision tomorrow, I think investors are maybe being a little cautious.
Okay, and it's a big earnings week in the United States. We know that those really big companies are going to be coming out with results. What companies are you looking at and why?
So big companies, definitely. You've got the likes of Apple, Amazon, Alphabet reporting. So I think we all know that the fourth quarter of last year wasn't terrible by now. I think it's now about guidance going forward. I think outlook is the big thing of where is the States going in terms of recessionary talk? How are these companies in terms of the health of their businesses and their balance sheets? Are they going to cut jobs? So I think it's more not necessarily about the actual numbers for the last quarter. It's more about the outlook statement. That's going to be the big driver of what happens to sentiment and how people are viewing things going forward.
When we go to Asia, we're seeing some losses. Why is that?
Again, I think you put it so succinctly at the beginning of the show. You've had a record month. You've seen a massive bounce out of Chinese stocks, which has flowed through nicely into the JSE. And I think you've just seen a little bit of risk being taken off the table and some profit taking. I still think that there is nice upside for the rest of the year, but I think the market's just consolidating, taking a bit of a breather, again, ahead of a huge week in terms of results in the States and some big kind of central bank decisions. So I think it'll continue, but just a little bit of consolidation.
Yeah, we know the ECB is coming out also with some decisions, but let's go to Europe for a moment. We saw that Germany's economy declined, surprising a lot of analysts. How, if in any way, did that affect their European markets?
So I think it's all a function of sentiments and again, kind of the health of these economies. And if you look at Europe and the UK versus somewhere like the States, they are a little bit behind the curve in terms of raising interest rates. Inflation's a little worse off there. I think from a kind of growth perspective, also not as strong as what we've seen in the States or resilient as we've seen in the States. So I think these things are all feeding into each other, and often sentiment can be a bigger driver of things than actual numbers. And Germany doesn't make a massive part of the world compared to, for example, the States. But again, it ties into sentiment.
Okay, so we know that the ECB is coming out with a decision and the Bank of England as well. It's almost a certainty at this point there's going to be a raise. Is that a correct assessment, or should we be thinking about how much of a raise is there going to be?
Exactly. Definitely a thing of, yes, it's going to happen, but how much they're going to do it. At the moment, markets penciling around 50 basis points for the ECB. And again, it's also about the detail. What are they kind of the points around growth? What are the points about going forward? So it's all the detail. We're so macroeconomic and data sensitive at the moment. That's what people are going to be going through the kind of statements and numbers with the fine-tooth comb is around the detail. I think 50 basis points is almost dead set at this stage.
Okay. Martin, you were speaking earlier on about how there's so much interconnection and the different markets are affecting each other. We know that what happens with the Fed affects most of the world economies. So what outside of that is moving our markets locally, or is that also a very intertwined story and we can't separate them?
So we can do little pockets of it. I mean, if you look at the JSE, about 40 to 50% of what happens to the JSE is affected by what happens in China. Commodities, NASPAS that flows into, NASPAS and process, which obviously flow back from Tencent. So about 40 to 50% of the South African market is kind of directly related to what happens in China. You've obviously got sentiment globally that means, do people want to go into riskier assets like i.e. South Africa and other emerging markets? So it is interconnected, but you've obviously got our local stories happening. You've got risk appetite globally, and then you've also got the China story. So a couple moving parts, but that's, I think, a nice, simple summary.
Okay, and as we wrap up, you've spoken about the data, the macroeconomic conditions that persist. There's a lot of warnings being sounded about the South African economy. Is there a reason for us to be panicking? Is there a reason for investors also to panic now? Because we're hearing that things are really probably going to get significantly worse.
So I think if we've learned one thing in the last few years about South African companies and South Africans is that we're very resilient. A lot of these companies are doing very well in terms of keeping costs down, managing the companies really well, and that's all reflected in the numbers. I mean, even if you look at some of the numbers out of ShopRite today, really good sales numbers. So South Africans are resilient, South African companies are resilient. Yes, we are facing headwinds. Things like Eskom aren't helping that from a GDP growth perspective. And obviously interest rates are a little high at the moment, but so far we're seeming to do okay in a very, very tough environment. Hopefully that continues. And I think also if you put that next to what's happening in our market is still quite cheap from a valuation perspective. Offshore markets are, while they've sold off, aren't that cheap from a valuation perspective. South Africa is still looking cheap and still offers value. So I think we can make money in the JSE this year, and we have already. And I think hopefully our companies will continue to do what they've done in the last few years, which is be resilient in a tough environment.
Martin Smith from Anchor Capital is adding a little bit of hope to that very gloomy outlook. Thanks so much for your time on SABC News this afternoon. It's time for a short break. When we come back, we'll have more news for you. We'll be focusing on the Department of Mineral Resources and Energy and what they've been saying about fatalities, injuries and diseases there. Do stay with us on Point.